So let me ask the first question. Is I put up an interest rate forecast, which is above consensus, so I'd like to get an opinion of the panel. Is we have the Fed raising rates 25 basis points next week, which most people assume is baked in the cake. So we have 3 Fed tightenings next year, 4 in 2019. So that's 175 basis points beyond next week. And we also could see the 10-year Treasury, because of higher inflation, going to somewhere high 3s, possibly 4%. So how aggressive is that? Agree, disagree, what have you? So anybody want to take the rate forecast first so we know where UCLA is compared to the panel?
We're a bunch of talkers, I guess.
Yeah, okay.
Well, go ahead.
Listen, I say I have to stick my neck out every quarter on this thing.
Sure.
Okay.
So UBS's forecast goes out 12 months, so it's not into 2019. And maybe a little bit later, we'll get into what we think is happening with the U.S. economy. But as far as interest rates are concerned, we see the Fed raising, likewise in December, 25 basis points, 2 times next year. And the expectation for the end of 2018 on the 10-year Treasury is about at 2.8%. So I think we're a little bit lower than we should be, but that's the official where the bank is on the 10-year, 1 year out.
Where are you at Wells Fargo?
So if I remember correctly, our year-end target for 2018 is 255, so we're a bit lower than that. Part of what we're seeing is there's not as much inflation. I think our inflation expectations are lower than yours. And we're talking about a curve flattener as well. And when you look at some of the things that we put up on the presentation, capacity utilization, inflation trends, it's hard to see a very big spike up. So we're still in the mid-2s.
Okay, so rates are essentially flat for 3 years, basically.
Basically.
Okay, Chris, we 2 academics. Do you want to stick your necks out?
Yeah,
Academics are reluctant
so
to
in
do
my
that.
in my ivory tower, I would take the under of your forecast. I think we have a new Fed chair coming in next year, probably a little bit more passive, be conservative. I also read an article. One of the Fed governors said today that maybe they should wait till September next year to raise rates.
That's Kashkari.
Yeah. So so anyway, we'll see. But I would probably take the under on that, on your forecast.
Eva?
It's not my expertise. I can hold forth on the relation between interest rates and inflation, but by themselves, I don't have that much to say.
Oh, okay. All right. Let's go to the stock market. Certainly, there's been a lot of exuberance.
Yes.
And by exuberance, what I mean is the market has quadrupled off of the March 2009 lows.
Right.
And the market is up around 25% since the election last year. And price earnings ratios are high by historical standards based on current earnings and based on the cyclically adjusted P/E ratio of Professor Schiller at Yale. So my question is the exuberance rational or is it irrational?
It's funny you say this, because I put forth the belief that 2.5 years ago that multiples are actually too low, and that what you would see was irrational exuberance. In other words, you would start to see multiples expand, and we've reached that level. So we think what you see right here, right now, is right. Now, as we look forward, what we're looking at is, are we going to bring it to another level? And what we saw back in 2017 is the IPO market was very hot. The M&A market was very hot. You're not seeing that same thing at this point in time. So we don't think multiples actually expand here. And we actually think at 20 times earnings, when the 10 years at 2.4, 2.3, and credit spreads are historically tight, this is a proper multiple. And we should have been here, and they were actually too low several years ago.
Go ahead.
Sure.
Harlan?
I'll kind of start with how we got here,
Okay.
which is answering your question, and where we think we are, and what kind of concerns we have. So I really think that it's rational where we have gotten to, and I think the market has moved in measured response to tremendous growth in earnings. And the market's not focused on Washington. What Washington says and does is at the margin. Some of the policies are pro-business, and market likes that, and some are anti-business, the market doesn't like it. But when you look at earnings growth, the first quarter of 2017, S&P 500 earnings were up 14% year over year. The second quarter was 10% year over year. The third quarter was 5%, but probably would have been a 7 or 8% with, but because of hurricane-related one-time expenses came in a little bit lower. So we got here because of earnings growth. And I think moving forward, when you look at PE ratios, they are high historically. UBS expects S&P to earn about $131 a share this year, which would put the
That's consensus.
at about a 20 PE. The official number is 146 next year, which is 18 and a half. If we get some a little bit more benefit from tax reform, which you talked about M&A activity that could take some supply out of the market, and you could see that we're starting to get whispers from some of the trading desks that the 146 number could be a little bit low and it could be a little bit higher. So moving forward, we're pretty modest in terms of the expectation. If you get, let's say, even the 150 and you put an 18.5 times earnings ratio on that, that's maybe a 6% increase in the S&P 500. I can talk a little bit about what we're concerned about, or if
We'll take
you
that
want,
in a
we can
little
come
bit.
back to that
We'll
later.
come back to that.
Okay.
Ivo?
I'm going to state the obvious. It's incredibly hard to forecast the stock market. I think the best forecast of the stock market, typically for any mere mortals like us, is to predict it to be not that different from what is now, with a little bit of growth up over time. Numbers between 1% to 3%. I've had lots of Nobel Prize winning colleagues, academics, tell me how easy it is to do the stock market, to beat the stock market, to forecast from earnings, from this, from that. I think they're all out of business these days. The one thing that I advise to friends of mine is be aware that we had a 2008, which almost everyone seems to have forgotten. If the stock market drops by a third or by a half, can you still live the same way? And so in my own portfolio, at least, I'm relatively cautious. I am aware that I cannot predict the stock market, but I also want to be very aware that if the stock market goes down, I will still live, I will still come here, my house will still be here, although that's not the case with the fires at the moment. But I think caution is appropriate. The expected rate of return on the stock market is probably fairly low, on the order of 1% to 3%.
No, you have to define the 1% to 3%, because the audience thinks 1.3 to 3% absolute. You think it's risk premium?
Yes, I think that's the risk premium. It's above the risk-free rate. But again, you have to be very, very careful, and much more careful than most practitioners are in this respect. If you have something that goes up by 10% and goes down by 10% half the time, you lose money.
Right.
That's just a simple geometric compounding effect.
Right.
So we have to actually specify, when we talk about numbers that are that small, given the volatility in the stock market, exactly what we mean and be so accurate about it. But 1% to 3% equity premium, 1 is more geometric, 3 is more arithmetic.
So that defines in English, in English is with a 10-year treasury at 2.3 today, that's a long run rate of return between 3.3 and 5.3%, which is a lot less than quadrupling over 9 years.
Can I add something else? So there's a big misconception that interest rates are historically incredibly low. The normal story is that everyone is chasing yields because they are so low, and that's the reason why the stock market has gone up and why this is so high. It turns out that that's not necessarily the case if you consider that there are taxes as well. So take a simple example, and I hope it's simple enough.
Okay.
We have a 20% interest rate and a 15% inflation that gives you a 5% real rate. Well, not really, because what's taxed is the 20% nominal interest rates. So you have a hugely negative real rate of return after taxes. Consider the opposite, 5% interest rate, 0% inflation. Now you're only being taxed on 5%, not on 20%. So your relative performance is much better. We have had very low interest rates, but we've also had very low inflation rates. And because taxes are assessed on nominal rates by historical standards, what a retail investor is getting in real returns after tax has not been unusually low at all. In fact, it's just been about normal. That flows a little bit into the question whether it's exuberant, rational, or irrational, because rationally you would look at this and say, yeah, I have a great interest rate in fixed income securities because my taxes are now much lower, so I don't have to go into the stock market. But you read everywhere, well, I have to go into the stock market because interest rates have been so low. So it's that part I cannot really answer, but it certainly goes against the standard narrative.
Okay. Chris?
So, if you take my MBA corporate finance course, if you've ever seen the perpetuity formula, which a stock is estimated as, it's R minus G, right? So interest rates go down, price of stocks go up, growth rates go up, price of stocks go up, right? It makes the denominator smaller. So certainly, ignoring Ivo's comment for the moment about post-tax interest rates, interest rates have been pretty low on a nominal census, that's what we put in the formula. But growth rates aren't as good as they were in the 90s, as was pointed out by Chris here. So I think the multiple is probably very high. It's a historic high. Is it irrational? It's very difficult to say if it's irrational when we're sitting here. It's not a incredibly crazy number like it was at the end of 1999. But I think the issue for the stock market going forward, and this gets back to earnings, is if you actually do the math on the tax bill, it's not really worth that much to S&P 500 companies. They pay an effective tax rate of 24% right now. So if they take it to 20% on $100 of earnings, they make $80 instead of 76. And then when that gets passed down to a consumer, they pay 30%. So you're going to see an increase of earnings of 4% from the tax bill, which is not really worth all that much. Profit margins in terms of the overall economy are at historic highs. And so it's really difficult to think about how earnings are going to grow up unless the top line goes up. And if you look at top line growth, you're probably looking at whatever nominal GDP is, which is about 6%. So, I don't know if the multipliers are irrationally high. No, earnings have been very good recently. But I think going forward, I think it gets back to the same kind of comments you've heard, that I think mid-single digit stock market growth for the next few years is probably.
So long run rate of return 5% plus or minus?
Yeah, I'm not sure you're defining long run, but it's.
Well, from here, where would be long run?
Long run, like 5 years, I would say, probably 5-6% average.
Okay.
The problem is people think there's going to, I don't understand how the economists think we're going to get a 1% growth in GDP from the tax bill. We're at full employment.
Well, that's 1% over 10 years.
Yeah.
So 1/10 of 1%. It's 1/10 of 1%.
Okay, there we go. That makes sense. Because we're at full employment, so we're not going to get anything out of it. And so anyway.
No, because the CBO number and the committee was 0.8%, 10 years out. So it's like very tiny number.
So I just saw the headline. I thought it was pretty.
Look at the headline. You don't look at the headline. What's your view on a long run rate of return, Harv? Because you advise pension plans, you advise endowments. It's a very serious number when you put down what the long run rate of return for equity is and what the long run rate of return for fixed income is. These are very serious numbers actuarially.
Right. So, our forward-looking capital market assumptions for the equity markets, we're expecting lower returns than have been historically, right? And we're expecting a higher volatility than what we've seen. We've been through a period where the numbers got reversed. The S&P 500 coming out of 2008 has averaged about 18.5% a year, with a standard deviation, which would be a measure of volatility, at 9. Historically, that's been reversed, right? So that you've had returns in the S&P at about 9 and standard deviations about 17 or 18. So we'll maybe later talk a little bit about complacency and what that all means, but getting back to your question, we think that's reversing. So we think volatility is going up. We think that the kind of expected returns on the market should be lower than what we've been seeing. So I think we're looking long term. No, we're looking at about 8%, I think, is what we're using in our models for equity returns moving forward.
From current levels?
Correct.
Okay.
Yeah, long term, if we're doing an asset allocation study and we're looking at a long term for an endowment, we're using an 8% number. and volatility number probably, I'm not sure exactly, but probably like a 15% standard deviation, 14%. So we see over the long term that it should go higher.
Okay. Now I have a question on fixed income. With fixed income rates, treasuries at 2.3%, corporate bonds, investment grade, call it 3.5 to pick a number. Does fixed income have a role in an individual's portfolio? And if it does have a role, where does it belong? Chris?
So, I mean, I think probably for most people, you'd want to have some fixed income allocation. I mean, if you look at what happens when the market crashes, a lot of correlations go toward one. You know, I mean, people think about international stocks as diversification, but almost all international economies get all of their sales from the U.S. So when the U.S. crashes, international markets crash.
Right.
Little known fact is the U.S. actually outperformed in the financial crisis, even though we think of that as a U.S. phenomenon. So the only thing that really is uncorrelated with the market when it crashes is, you know, fixed income, U.S. Treasuries. So I think there's probably a place in your portfolio for it.
How much?
How much?
So let's say somebody,
I mean, it probably depends.
somebody who's 40 years old and somebody who's, say, 60 years old.
Well,
family.
so 60, I mean, if you're thinking about retiring soon, I'm not sure that, you know, I think the standard allocation model would say 50% equity, 50% bond. It's 110 minus your age, right? Obviously, if you're younger, I mean, I have a general philosophy, as I have Evo's philosophy, that I can't predict the market next year. So as someone who's approximately 40, I'll say that if the stock market's not higher in 30 years, I can't retire anyway. So I'm pretty heavily weighted in equity. But I mean, that's as I should be for my age. But I think if you're older, you know, you probably want to, and you know, you can't afford, as again Evo put it, to lose 30% of your portfolio and still retire. You probably want to have a significant chunk in treasuries. I mean, even if your duration's 6 and interest rates go up 100 basis points, with the yield, you still only lose 2% of your portfolio. Versus if interest rates go up 100%, the stock market probably will take a bigger hit than that. So,
the main important rule to remember is that if you have a fixed income allocation, it should preferentially go into your IRA or otherwise pension, tax preferred investment vehicle. The equity belongs into your retail account, the fixed income into your pension account. Otherwise, you're tax arbitraging yourself.
Your response is, I think, really interesting, and it's academically 100% right, and it's hard for people to do that. It really is. In other words, what Evo is saying is, and I'll get to your question, but I want to comment on this, is that you know, fixed income, you're going to be more efficient because of the, you know, we're assuming taxable fixed income,
Correct.
right? Where equities have tax preference, the dividends are at a lower rate, and if you're not selling it, you're not creating taxes, and if you sell it, you have a capital gains rate. But what happens psychologically, though, sometimes it's easier for an investor to say, okay, my retirement money I'm not going to touch for 30 years, and so they will make the other decision, right? They'll say, I'll go 100% equities in the retirement money, and then have their fixed income exposure. So sometimes from a rational or a, you know, just psychological perspective, it's easier for them to do that, while academically what you're saying is 100% correct, and very few people will take that advice, even though it's the right advice. As per fixed income, it's a challenge because we think interest rates are going to move higher, but you have an opinion on the market, and you can't bet 100% towards your opinion, so you have to allocate. And so absolutely, you're going to have exposure to equities as far as what the percentage is. There's so many dynamics in terms of, you know, cash flows that are coming in, cash flows out, income needs, how people sleep at night relative to risk. But I would say, as per the allocation of fixed income, we would be, if we have a long-term strategic allocation and that was determined to be between 30 and 40%, we'd be closer to the 30 within that band today. Again, that's just...
Okay.
And we would have a higher weighting to lower duration kinds of fixed income and funds that might invest in like floating rate debt and things of that nature that we think will do well on a strong economy, but have some ability to adjust their coupon if should rates go up.
Okay, let me ask a question. I know two of you, the academics, I'm going to leave out from talking stocks, but the two people have real jobs.
Wow.
since I've been on both sides, as an academic.
Which one's better? Which one's better?
On the private side. On that is, and we can't talk individual stocks, I'd like to talk sectors of the market. So which sectors would you like for 2018, and which sectors would you, or overweight, or,
Right.
and which sectors would you underweight in the market? And I'll just as a preface is, this year, for you, what you had was own the FANG stocks, which is Facebook, Apple, Google, Netflix. You were done, and you were up 40 or 50%. That was last year's allocation. What's this year's allocation?
Okay, so the way I would approach that is I'm going to look at volatility and I'm going to look at quality. We've already talked about quality, so I want to push up in quality. And there are certain sectors that give that to you. In addition to that, in a low volatility environment, at some point we're going to normalize. And because of valuations, I don't think clients should take that much risk. And so you want to look for lower volatility sectors and stocks. Now, we just wrote a note that puts you in certain sectors and industries such as food, beverage, tobacco, electric utilities, certain parts of the media space is where we're looking to put new money. But really the overarching theme is reduce the volatility of your portfolio, see if you can get yield up, all else being equal, and increase the quality. And where the sectors play out, it depends if you're a stock picker or it depends if you're just buying ETFs. And if you're buying ETFs, it would be in line with what we talked about, stock pickers per the quality and the volatility.
So you have a long-term allocation in the market, strategic mix, and then you're going to tweak it for what you see coming forward from a tactical perspective. And so you don't make 180-degree turns, but there are things that you can do, and you look forward and kind of seem to be in front of you. So one of them right now is we've slowly started to overweight large cap value and specifically financials. Value we see as beneficiaries of a stronger economy, and financials specifically also benefit from a stronger economy and should make more money in a rising interest rate environment. Just to talk a little bit about how you do this tactical work, which sounds more complicated than it is, it's often just common sense. Coming out of 2008, it was kind of easy to look around and see that the US was the strongest economy. So if you have an equity portfolio in the world, let's say is roughly 50-50 US and non-US, we allocated more towards the US. More recently, and looking forward, we see Europe and EM and other parts of the world as being a little bit better valuations and still experiencing pretty good growth and favorable central bank positions. So we've increased that. So maybe we were 20% non-US in 2009, and now we're about 40% non-US with a specific overweight in Europe. In the US, financials and large value were a little overweight, and outside of the US, Europe.
So you're underweight growth and small cap.
We've still, normalized weightings there. We had been kind of overweight large growth. If you go back 2 years, we just were in a situation where the economy was just not growing that rapidly. Companies were increasing their earnings by financial engineering, buying back stock, raising their dividends, and so on. And so with a very low GDP, the only kinds of companies that could get growth, and PEs were historically low in those areas. So, but moving forward, we think, that's, even though there's still growth, it's played out and gotten a little more expensive. And also want to thank you, because I can tell my mom now that I have a real job.
Yeah, that's good. Okay, very good.
David, I just wanted to point out one thing, because I talk about quality and low volatility, and just point out that QUAL is the quality ETF. So if you're an individual investor, that's something you might want to look at. In addition to that, there are 2 low volatility funds, USMV and SPLV, are ways to play that if you can't buy individual stocks or don't have the time to do it, how you get exposure to both those strategies.
Let me ask the questions to Ivo and Chris, because the standard academic advice for individuals for a very, very long time was to buy S&P index, low fees, hold it forever, and that's been the standard advice. And now we have a whole proliferation of products, which is different sectors, and what people have been talking about. So my question is passive investing, index investing overdone in the market? And in the sense is all this money is coming in, this is something, we have levels of indexation that are unprecedented. And the question is, does the market lose some overall efficiency when that happens? And two, what happens when people decide to go to the exits in this kind of environment, where instead of selling an individual stock, you're hitting the S&P 500 right away. So I'd like an academic perspective on that.
This is unfair, Chris. Maybe you should do that.
That's
It's a hard question.
Well, just say maybe. It depends. I think it depends.
That's
is
Jerry.
the answer.
Jerry, we need your slide up here, Jerry.
I'll go ahead first. So, I think I think as academics, we have said for a long time that generally managers can't beat the market. I think there's a lot of research that shows that managers generally can't beat the market, and that lower fee funds are the way to go. Now, there's been a huge shift in the last 2 years, and I don't think that, at least I don't think I can qualify how much the efficiency of the market has declined in the last 2 years because of passive. I will say, generally speaking, I mean, if you have a lot of money that are all chasing after the same stocks, that would, classic literature would say that those stocks probably are overpriced because there's been forced buying by mutual funds into those particular stocks that would then reverse later on when the flow stopped. But the question is, when does the flow stop moving from active to passive? So, I mean, I was actually joking the other day that I'd love to buy every stock that's not in a big index because it'll probably outperform the next 10 years. So
somebody will create an index for that.
well, yeah, exactly, and then it won't be an index anymore. But so actually, it's interesting. Speaking of SPLV, I mean, and I'm sure Ivo is familiar with the papers. There's some papers that actually show that the low volatility stocks in the S&P 500 have the same performance as the high volatility stocks with much less risk. And a lot of the rationale behind that is that if you look at all the passive funds, they have to hold cash for redemptions. If you look at classic mutual funds. And so the only way they can avoid underperforming the market is to have a higher weight on higher beta stocks to get their beta to 1. And so higher risk stocks are overpriced and under risk stocks are underpriced, right? And that creates the dichotomy there. So, I mean, I think it's very difficult. I mean, there's still trillions of dollars of active managers and mutual hedge funds and everyone else that are chasing after the market. So I'm not sure that market efficiency... For market efficiency to gone down, the money out of active mutual funds actually had to be smart and informative. Okay. And I don't know that there's a lot of academic research that would show that those people were generating a lot of information. So I'm not sure that efficiency has taken that much of a hit, but I could certainly see an argument that the hot money into passive has caused, generally speaking, the stocks they've allocated money to have a bit of an overpriced relative to the market. But.
I think Chris has said it all very well. The only thing that I might add is that, and I've written a paper on what happens to stocks that are just not in the index, in the S&P 500 index, or just in, just out, just moved around. It just requires a little bit of smart money to arbitrage any differential there. It doesn't have to be that most people are really very smart. It's just enough if a few people are very smart. So it makes a lot of sense that you should earn money by holding those stocks that are just outside the S&P 500 index. But when you look at it again, it's very, very hard to make money in the stock market.
I want to follow up on what Chris Harvey said in his presentation. He talked about a wave of M&A coming in 2018. And I want to raise 3 issues having to do with that. Normally when you have big M&A waves, it's normally the top of a cycle and things turn out very badly after it because most of the capital is misallocated in mergers where the acquirers tend to overpay and you have misallocation of capital and they go down. I think that's still most of the academic studies.
Yeah, the AOL merger is going to pay off one of these days.
So that's the first question. So does that mean well, enjoy 2018 because we got a real problem in 2019 and not up 2% market, but a market down in double digits. Also related to that, the tax bill makes it harder to do debt financed acquisition in some cases. And then the third question with an M&A wave is we have a different Justice Department, which is skeptical of, quote, vertical mergers, and the classic is ATT Time Warner, and who knows, there may be issues with CVS and Aetna, because that's also a vertical merger. And you have United Health and DaVita today, which is also sort of a vertical merger. And typically, the Justice Department hasn't looked at vertical mergers for 40 years. There's been no real antitrust issues. But all of a sudden, the new head of antitrust is looking at vertical mergers, and it plays into the populist instincts of our president. So you want to comment on, it's a big question.
So years ago, we did some studies on M&A activity, and it is true that it's not always economic. However, CEOs seem to have gotten some of that information. As we move forward in time, it's becoming, in some cases, more economic. And what I mean by that is when a public company takes over a private company, we've seen value occur. When the size of the companies are very small to very large, there has been some value created. As a whole, the answer is it is not.
Let me comment. When I was an analyst and a big merger was announced, and I went on the conference call, and the CEO of the acquiring company was saying this was a strategic merger.
Okay.
And my comment was, is the word strategic a synonym for overpay?
Usually I use the word synergies. When you hear synergies bandied about all the time, that's something that's very scary.
Well,
Please.
Well, net in net, it may well be that there is synergies and there is value created. That doesn't mean that they didn't overpay.
Right.
I mean, if I'm going to be cynical, which as a Boston guy I'm supposed to be, if I'm a CEO and I want to get a benefit from repatriated cash and line my pocket, I'm going to do a merger because the number one way I raise my pay is make my company bigger.
Right.
I mean, was the CEO of Aetna getting paid $500 million as part of the merger? So
Yeah, Aetna CEO is $500 million.
yeah, $500 million with the B. And so that's the easiest.
He's a seller.
Yeah, but still, it doesn't matter, right? I
Right.
mean, it's still, if you think about the CVS CEO, I'm sure he's going to get a huge raise for the bigger company, and I mean, that's just.
And the CVS shareholders paying that $500 million comp.
Of course, and so I think, I don't know. That would be my only comment. I don't think many M&A. I think the idea Chris had here, where you take an Apple who buys like a small company and tries to acquire their technology. I think those are generally more valuable. I'm sure everybody is happy that Facebook bought Instagram for $2 billion when it was a very missized merger, and that turned out well for them. But I think generally speaking, I think that when you have these big M&A deals, it's difficult to see whether or not they were good or not, and there's lots of examples where they weren't good.
Anything further, Chris?
No, nothing further. I think you're right. It is often you do see a peak when M&A activity gets hot, and often what you see is what happens is the first mover has the advantage, and then other people get worried, or they get phone calls from my bankers, and they do things that on paper looks rather smart, but in actuality less so. And so you have to be very careful about that.
Okay, now before I turn it over to the audience, I just have a question. Any comments on the hottest bull market in the world right now, which is Bitcoin, which has gone from about $1 to $12,000 or $13,000, and it's up from $1,000 to $13,000 this year. Anybody have any comments on Bitcoin?
I hope you're not advising my UC pension fund to put all its money into Bitcoin.
I'll tell you from the perspective of our economists, and this doesn't answer the question as to whether it's going up or down, because I think in his words it's a speculation and it's a bubble, but whether it goes higher or lower, we don't know. But what he does say, and I think it's compelling, is that it's never going to be a currency because governments won't accept it for payment of taxes.
That's the key.
And that's key. So it won't become a currency. And then the other, as a consumer, if you're getting paid and your goal is when you get your paycheck, you're going to go buy a TV, and the TV is $500. And if you get paid in dollars, that when you go to buy that TV within the next week or two, that you've got $500 to buy the TV. And if you get paid in Bitcoin, you may have $750, but you might have $300, and that's not a choice the average worker is going to want to make in terms of getting paid in Bitcoin. So we don't see it as a currency, but we just have no way to know if it's what the value is, and when does it end?
There is an unambiguous value at the end. At the end, it will be worth 0. In between, there's no reason, given that it's trading at 13,000, there's no reason why it couldn't be 1.3 million. Okay, so it could be $13, it could be $1,300, or it could be 1.3 million. So it's really hard to, and of course it's almost impossible to short it. It's very, very hard to bet against it. And I don't know when it's going to burst, but in the end, the value will be 0.
Let me make a related comment. Most economists have said that it's very hard to understand the bubble while you're in it. It's very hard to recognize a bubble while you're in it. But it seems to be that most of the economics profession right now thinks Bitcoin's in a bubble. Is that a fair comment?
Yes.
Well, I had an interesting conversation with Gene Fama, who of course
Yes.
won the Nobel Prize last week about Bitcoin, where he tried to redefine what a bubble is.
Okay.
But when I actually define it in the more normal terms, we don't know when it's going to end. Even Gene is agreeing that this is a bubble.
That's a big deal. That is a, so Chris?
Yeah, I'll just make 2 comments. So one is whenever they call Bitcoin a currency, I just want to strangle someone. It doesn't meet any of the definitions of a currency. And getting back to our own point, the only thing more volatile than the value of Bitcoin is the stake that I have at the craps table when I play in Vegas. I mean, they pretty much go up and down at the same rate. And the second thing is Bitcoin can never be a currency in a modern economy, period. Any currency that has a finite amount can never, ever, ever, ever be a currency in a modern economy, right? It's just fundamental. You have $500, you have 500 real goods. Price is $1 per good. 10 years from now, you still have $500, and now you have 1,000 real goods, and what happened to the price of the real goods per unit? Price went down. That does not work in a modern economy, right? Do you want your income to go down by 50%? Do you want the value of your home to go down by 50%? You don't. That's why it never works to have a fixed currency in a modern economy, and that's why no country will ever successfully use the gold standard again, ever. Yeah. It just doesn't work.
Okay, thank you very much, everybody. Thank you, panel.